Hi, everybody, and welcome to another special episode of our Made for YouTube series where we talk about what's happening in mutual funds in greater detail. So, joining me today, I have Ashwin Patni, who's the head of products at Access AMC. Hi, Ashwin. Thanks very much for joining in. And, today Ashwin has joined us to talk about ETFs, so the passive market. And why I say ETFs and passive almost interchangeably is because, well, ETFs is the largest constituent of the passive market, but of course there are index funds, fund of funds, etc. But currently ETFs, or you can say the passive industry, is about 1/10 the size of the total mutual fund industry, right? But it is certainly something which is snowballing, right? It's every month we're seeing a lot more money going into ETFs than it was the previous month. So, what is the future? I mean, is it an idea whose time has come? Is there still, some way to go? And also, how do you add ETFs? How do you select it? Which is the best way to go about it? So, Ashwin is going to help us answer all of those queries. So, Ashwin, first up, what's with all the NFOs, right? I mean, every other week we are seeing one passive NFO or the other. Is it getting too crowded?
Um, so I think the short answer is not yet, because what we are seeing is essentially a little bit of the industry reaching a more mature phase of its evolution. We've had for the longest time the ETFs that we had were relatively basic in nature, which allowed the mainstream sort of indices like Nifty or Sensex, or sort of things like gold. So we had the vanilla ETFs, which were pretty much dominating. Of course, over the last few years, one big new addition was the initiatives by the government, some of the divestment ETFs that we saw. But those are special cases. I think from an industry perspective, the dominating ETFs were the traditional indexes. And now we are at a phase where, as people have become more and more comfortable about ETFs, as reflected also in the rising AUM, but also rising use of ETFs in the form of trading volumes, etc., on the market. And now I think it's a logical time for the industry to then broad base itself to offer more choices to the investors. I'll also highlight this is not something that is unique in India. We have seen this happening across the more developed markets over the last 20-30 years, where as the market matures, you start seeing more innovation on product development, more innovation in terms of the types of funds that are done. Just two things maybe I can highlight just in terms of two big categories where work is going on. I think you're seeing a lot of sector specific launches. People can participate in sector baskets through ETFs, whether it's banking, technology, healthcare, stuff like that. Or you are seeing certain what is called smart beta, which is basically factor-based indexes, which allow you to participate in a particular factor like quality or growth or value, etc. So you are seeing the industry reflect that. So yeah, it's an exciting time, lots of new things happening, and I think interesting time also from an investor's perspective.
Well, Ashwin, while I understand that that the industry is working towards offering a wider basket of ETFs, but I thought the whole point of having an ETF was to just replicate the market, just be the market. So, what's the point of having thematic ETFs? I mean, is there a larger thinking to this?
Yeah, so I think it's essentially boils down to the fact that in such a large market, there are so many different types of investors out there, and different investors have different objectives. So yes, for a large number of regular investors, just a simple ETF that allows you access to the Nifty or a market-based, broad-based index is probably a good and sort of will serve most of the purpose. But there are sophisticated investors, there are investors who are looking to do something very specific in their portfolio. And that's where, some of these customized ones can really help, things like thematic and smart beta. So yeah, it's a little bit, the industry trying to cater to different investor demands. I won't argue that every ETF is good for every investor, but it's a question of finding the correct segment for each of us.
Okay, so basically that the basket will be available, but not necessarily as part of someone's core portfolio, right? I mean, because even in the actively managed side, we've seen experts not really recommending thematic funds, saying that perhaps as a tactical play or in your add-on portfolio. So is that how it works with ETFs as well?
Absolutely. In fact, just speaking from our own experience on the active side, we've never launched a sector fund for the same reason, because we felt that for retail investors, it's always difficult to position these kind of products in their portfolio, and the more diversified funds probably work much better. In ETFs, however, there is a very good range of investors. You have right from institutional investors, corporate investors, sophisticated HNIs, and maybe to a lesser extent retail today. But over time, we do think retail will come in as well. And that's where I think some of these products can be interesting, because people do have just like they want to trade stocks, etc., they do want to take sector calls, etc., and take some of the thematic calls, etc. And the beauty of ETFs, of course, is, as we all know, is that you can trade intraday with ETFs. They trade right through the day. You can express intraday views, etc., with them as well. So for if you are a sophisticated investor, if you are active in the market, instead of buying and selling a stock, could you buy and sell a basket which also allows you to take that? You just, I mean, think of it like that. So I think that's right. That's probably how we would look at
The
some of
beauty of ETFs, and also the fallback, right? Because we've always told mutual fund investors at least to remain invested for the long term. So I guess, yeah, they have to, get over this behavioral aspect that, while they do have an option to trade, they do, they may choose not to exercise it as well. Okay, Ashwin, now for an ETF investor, unlike active fund management, where the fund manager plays such a big role, the house style, etc., etc. In ETFs, the defining factor would, I guess, be cost. Right now, what are the factors which influence cost? One is, of course, the bare minimum, expenses, etc. But there is also a tracking error, right, which alters the returns, etc. And how does it all tie in together? Is tracking error very common, and at what percentage should somebody get alarmed?
So I'll answer it in 2 or 3 parts. Your first part is, what is the total cost in that sense? And that's a very good question to ask, because essentially, as you rightly said, expense ratio is the optically the one part of the expense, but the other part is tracking error. And also there is a third part, which is also any bid offer spread, because a lot of investors are buying it on the exchange. So what is the how far away from the NAV is the price that they get, would be a third sort of implied cost to them when they buy or sell. To answer the second part of your question on tracking error, I think for most ETFs, it is possible to keep tracking error very, very tight. The simple reason being that the structure of ETF really is supportive towards keeping tracking error down. As we all know, ETFs typically, the way they work is that the baskets are managed by the fund house, and small retail investors buy sell on the exchange. What that does is it prevents any small cash inflow outflow management activity at the fund house, which typically could give rise to higher tracking error, and it allows the fund house to really replicate the basket in a very concise and crisp manner. So what we have seen, yes, it's not possible to have tracking error completely eliminated, but what we have seen is that, especially for the mainstream indexes, tracking errors are very, very tight, of the order of magnitude, which is well below even 0.5%. In fact, in basis points. And the only place where I would be a little watchful is if you are looking at ETFs which are in the more illiquid segments of the market, let's say on the mid cap, small cap side, or something that is less easily replicable, then tracking error starts becoming a bigger issue. But for mainstream large cap liquid baskets, it's very, very tightly managed by the industry.
Okay, Ashwin, now the other thing which you mentioned, which is the smart beta ETFs, right? So smart beta, by the way, for those who are watching, is like rule-based investing, right? So you'll have a certain set of rules, or Ashwin also called it factor investing. So you choose a factor, which could be anything, right? It could be risk, it could be quality, it could be style of investing, value or growth, or momentum. So any of these factors, you choose it, you align an index to that factor, and you present an ETF. Ashwin, what is the currently, what's the work that's happening over here? What is the scope for this category? And would it always outperform, an index ETF because it is so designed?
So I think great, fantastic questions, and really very, very interesting space in the market right now. Very nascent, but I think something that will really develop in the next few years. Uh, Very quickly, smart beta is essentially trying to capture one or more factors which really can deliver outperformance or deliver a particular uh, tilt to the portfolio. So let me give a couple of examples to explain. You could, as an investor, say that I want my portfolio to be tilted in favor of growth stocks or quality stocks or stocks that have a strong momentum. And essentially, what this approach does is essentially isolate those stocks that are very strong on these particular parameter which we have identified, and create a replicable basket based on that. So very similar to passive investing, except that in a normal, let's say a Nifty or Sensex, it's market cap based weightages. Here you are weighting it by the particular factor, whether it's, like I said, quality, growth, etc. So yes, it's a very exciting field. It's something that globally has really picked up. To answer your question on performance, I think the idea is any good quality factor that should deliver long-term performance, but in the near term, you could always have market cycles. As we all know, like values done well last year, quality growth did much better before that. So market goes through cycles. As long as investors come in with their eyes open, they are sensitive to the fact that near-term ups and downs can happen. I think smart beta can really add a lot of value to investor portfolios.
Okay, any factor that works better than others for a retail investor? I mean, somebody who may not be able to time their entry or exit. So, if you have an index ETF and you want to add on a smart beta, what would go well?
I would say that, ultimately, speaking more now, wearing the hat of what we have seen as managers in India, I think India is essentially a growth market. And it's a growth market where quality stocks have done well. So essentially, any combination of quality and growth is something that I would believe is probably the most robust combination from a longer term perspective for investors.
Okay, and growth is also the house style of access, right? Okay, Ashwin, anything else that investors need to look out for? Because we have extolled the virtues of ETF at every opportunity we have gotten. Not enough has been spoken about. What are the drawbacks, or what are the precautions investors should take? So, what can we tell them? About what might be the negatives of holding an ETF?
I think you said it perfectly in terms of the fact that there is a plethora of NFOs happening, always something that can cause confusion, especially for more retail investors who are looking at a more simple portfolio. I think important thing is to not get swayed by the tens or twenties or hundreds of these different funds which are around there. Maybe more sophisticated investors can handle them, but for normal investors, remain very simple and focused on the mainstream indexes. I think that's one important thing. The second is, while we all extol the benefits of daily intraday, the fact that ETFs can trade, ultimately these are equity funds, right? So therefore, to get the best outcome from these require long-term allocations. So the convenience of day trading is there, but it does not mean that ETFs, we want them to be used as a day trading instrument necessarily by investors. They should essentially be used as long-term investors. So these are the two things I would really highlight, which is don't let the plethora of choices confuse you. Remain focused on the mainstream, long-term ideas. And second is don't use these for necessarily short-term trading only. Just use them more as regular long-term allocations, really to get the best benefit.
Okay, Ashwin, one final question to wrap up, and this is something that I'm curious about, and I'm sure as are a lot of viewers, is that why would a fund house want to, sort of share the ETF basket with their active funds? Because active funds would earn you fee, right? I mean, after all, a business needs money to run. ETFs, wouldn't have the kind of margins that active funds would have. And therefore, I mean, what is an AMC's interest in pushing an ETF product?
I think we are trying to cater ourselves for all the different investor needs. We recognize that while of course if you ask us, we have very strong views in terms of the fact that we can add alpha, but at the same time we recognize that different investors have different needs, and a particular product may not be the only way to get there. And that's where I think really as manufacturers, it's our job to make sure that we provide this choice, a full range of products. Just to give a very, very different example, you could have a balanced fund which combines debt and equity, but you also have debt and equity offered separately, and different investors can use it in their way. The same way you offer, a host of different choices, and basically rely on each investor figuring out what works best for them. Because all things equal, I think having a little bit of choice is something that it should benefit investors.
Okay, so if you're a full service AMC, you have to provide full service. Ashwin, thanks very much for joining in. And of course, as the industry grows, we'll have a lot more to talk about ETFs and passives in the future as well. Thanks very much at the moment for joining in.
Thank you so much. Yeah.
Okay, so there you have it. And, incidentally, for everybody who's watching this video, I also did a basic primer on passives in India. So basically what the industry is, how big it is, how it's growing, what are the various products. So we're going to put the link down in the description. So if you want a basic workshop on how to go about passives, you may want to check out that link as well. Thanks very much for watching. I look forward to hearing from you and reading all your comments.